All right. Good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here once again with the Last Week in Mortgage Today, our weekly whirlwind through all the latest happenings in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, I am thrilled to be joined by the president of Republic State Mortgage, Paulina McGrath. Paulina, thanks for joining me.
Absolutely. Thanks for having me, Rich.
And I just want to say at the beginning, like you are somebody with a really stellar industry reputation that, as you know, I've been like calling and emailing you for years, like about TMC. I really appreciate you giving TMC a try and for joining me in the co-host seat this afternoon, and really looking forward to the discussion.
Well, it's my pleasure. And I have to say, you embarrassed me a little bit by saying those things, but I will say I'm obviously very stubborn and probably a little bit to my detriment, because since we've joined TMC, it's been a really great experience and we're really thrilled to be one of your newer members.
That's awesome. Thank you very much for saying that. And it's great to have you on board. So let's get right into it. Before we get into the program, Paulina, why don't you give our audience a little overview of Republic State Mortgage, or the origination volume, general model, to kind of level set for the discussion here?
Absolutely. So Republic State Mortgage has been around for 26 plus years. We are predominantly a retail shop. We dipped our toe into wholesale about almost 2 years ago, and it's now about 10% of our volume, but still we're predominantly retail. It has been a great ride for Republic. We've sort of grown very systematically. Some would say perhaps too slowly, but for Robert Wagner, who's the founder of our company and CEO, and I, it's been a really great ride. We've really focused on relationship building. We're predominantly a purchase money company. So for us, our relationships with our realtors and our builders is first and foremost, and our customers, of course. So we are truly relationship driven. We get the vast majority of our business from realtors, builders, and repeat customers, and we're thrilled by that. And we lend in about 15 states. Last year, our volume was just under 1.3 billion. We anticipate that this year we'll do a little bit over that, about 1.35, something like that. So I think hopefully that answers your question, gives you kind of a little snapshot about us.
Absolutely. Yeah, no, thanks for going through that. And also want to mention to the attendees, any comments, questions, thoughts, anything, please strive for the show to be interactive. So feel free to type it in the chat with the Q&A. We're happy to be voice it aloud. And I see my friend Rob Krisman already giving me a hard time, asking what minor league stadium that is on the wall behind me. That is, of course, Progressive Field, the home of the Cleveland Indians. But Rob, I know, knows that. So we're, I think, 10 games over 500, despite the youngest roster and lowest payroll in all of baseball. But topic for another show. So Paulina, let's get right into the news headlines from the last week. I want to get your thoughts and reaction on some of the things going on in our industry. HUD with an announcement, I believe on Friday, in and around relaxation of guidelines regarding student debt calculation as one way to help encourage more home ownership. Obviously, affordability is an issue right now with home values going up. So just your thoughts on that announcement. How much of a game changer is that? Is it like minor? Is it, how do you view that announcement?
We welcomed it. Absolutely. I mean, it's definitely something that is going to help homeownership, no doubt. I mean, if anything, it's going to level the playing field a little bit more, just to get things more in line with Freddie and USDA. It's still not quite as forgiving as, say, Fannie Mae's guidelines and BA's, but just the fact that it's still a vast improvement. And so I think it will have a big benefit to improving access to homeownership.
Awesome. Some other news that came out this week, and it was like one of those things that surprised me at first when I read it, and then the more I thought about it, it didn't. We've been talking about it on this show and my show with Rob, just the rise of the non-banks. You go back to pre-mortgage meltdown, and the money center banks, I think at that point were at somewhere between a 2/3, 3/4, maybe 80% market share of all the mortgage originations in America. We saw a lot of them pull back then, and really have not gotten back into the degree that they were before. The HMDA data for 2020 came out, non-banks, 68.1% of the mortgage lending in America in 2020. 7 of the 10 largest. You've been running a non-bank mortgage company for a big chunk of your life. Talk to me about non-banks, the rise in market share, and also maybe does it give you any pause, the way that a more aggressive regulatory community coming with the new presidential administration might look at that number? They like banks from the standpoint that they're regulated by the banking entities, and it's more all under one thumb. And I think to some degree, the non-banks make them a little nervous because there's more of them, it's more scattered. The regulatory framework is not as built out. So we'd love to hear your reaction just to the rise of non-banks to what I believe has to be their highest market share of all time.
Absolutely. No, I don't think there's any question that it's the highest of all time. And I think the thing that's been pretty dramatic has been just the rapid increase, right? I think I saw statistics somewhere where the percentage was 25% in 2009. I mean, if that's accurate, that's staggering, the increase. I think it's not terribly surprising given the exit of the banks from a lot of the government lending in after the crash of 2008. I think that it's also not surprising given the fact that, of course I'm biased, but I think that IMBs are far more nimble. We're far more focused on just the everyday lender. We're neighborhood lenders. So it's our ability to reach out and really grab market share is not surprising at all to me. I feel like we're able to definitely get loans done quicker, more efficiently than a lot of the big banks, and we're able to foster more competition, innovation. So it's not surprising at all to me that we would have be picking up market share. But to your point, Rich, I think there is going to be some folks in DC that think too much too soon, that there could be some sort of risk here. I mean, I think we've been hearing that fear, which I think is pretty misplaced for many years now. I mean, particularly some of the think tanks in DC have been, crying wolf about the risks of IMBs for many years, and I don't think there's any truth to it. I think that IMBs are properly regulated. There's no doubt. I mean, I think at any given month, I have 1 or 2 different regulators in my company doing an audit of some kind. And so I don't think that there's any truth to the fact that we are riskier lenders. I would also argue that from the servicing side of things, we've proven, particularly during this pandemic, that, I think one of the other fears is this lack of liquidity potentially for IMBs. And I don't think that's true either. I think that's been proven by the success that servicers have had during this pandemic and the extended forbearances that we've seen due to the pandemic. I would also say that, another thing we've heard out there is that IMBs don't have enough skin in the game, or that, that there's easier for IMBs to just walk away. And I don't think that's the case at all. As somebody who is an owner of an IMB, I know that, we have to keep a significant amount of our net worth in the company. We have to oftentimes sign personal guarantees, and that's not something that the banks have to do. And so I think that in many respects, it's not accurate what they're saying about IMBs. And I hope that the regulators will listen to the fact that the IMBs have really filled a giant void that was left by the banks. And if you look at the percentage of, particularly of low to moderate income borrowers that we're serving, and minorities, families served by IMBs. If there were to do any significant added regulation, I say added because I think we're already overregulated, it would be very detrimental to the country, and particularly to those homeowners that we really need to serve, those folks who are disproportionately not represented in home ownership within our country. So I hope that the government will listen to the fact that IMBs are once again filling the void, doing what they need to do to serve the homeowners and prospective homeowners, and will ease up, give us a little break.
Very well stated. Honestly, you take that last few minutes snippet and maybe get that off to some people in DC, because I think that was very well put. And you're right. I mean, there was a big gap that was created when the big money center banks basically pulled out of government lending and other types of lending in general, and has been filled by the IMBs and the filling the chasm, as you noted. So, and you know, my fear is that this rise in market share will cause them to think too fast, too soon. I was working for and running lending for a community bank around the time of the meltdown, and I saw how community banks got lumped in. I think, you know, Dodd-Frank and all the regulatory changes during that period of time, and how it really boots on the ground was very penal to a community bank that I worked for that did nothing wrong and had always very high standards and never made any of those loans. So yeah, that is my fear, and I hope I'm wrong, that we don't see the regulatory winds of change blowing harder, because non-banks have stepped up and filled a needed void for minorities, different demographics, and first-time home buyers.
Absolutely.
Moving on to other items in the news, existing home sales. The report just came out today, down for the fourth month in a row. There's some interesting components to this report. The Midwest was actually up, and then we saw some pockets on the coast that were down year over year. But really of note, the median home sale price in May of 2021, over $350,000. A year ago, May of 2020, $283,000. That is a 24% increase year over year. Talk to me just about home values in general, your thoughts on where they are right now, how you see home values playing out over the course of the next year or two, and just what enters your mind as a business owner, you know, about when you see value increases like this.
Well, it's troubling. There's no doubt. We're seeing it, I think, in just about every single market that we're in. You know, we lend, as I mentioned, in 15 states, and we do tend to lend in sort of middle America. But we are absolutely seeing just incredible demands, and just the inventory shortfall is very dramatic. We're seeing some folks, some prospective buyers, just completely dropping out of the market just because they think, you know, I can't compete, because the get into these bidding wars that are just going through the roof, and they don't feel that it's the right time to buy for them. So I'm not at all surprised by the decline and by the increase in home prices. I do think that we're going to see this at least for another, unfortunately, maybe 3-6 months. Hopefully not too much more beyond that at some point. But I think realistically, it's going to take a while for inventory to catch up, and so I think we're just going to continue to see this increase in prices. Yeah,
one somewhat positive item in the report is the month-over-month increase in for sale inventory was up 7%, still far below where it needs to be in historically very low levels, but at least it's going in the right direction.
Yeah,
I think you hit the nail on the head. There's no immediate cure for the inventory issue. We're seeing lumber prices now are starting to plummet back down to, you know, their more historical levels of prices. But as you know, home builders have been pausing projects and not moving forward with projects, and that even if they all started building like crazy tomorrow, which is not going to happen, you're still looking at some runway there. So what is just in general, like the market in Texas has to be, I mean, we talked to everybody we have in the co-host seat, try to get a little sense of the local flavor of their market. But I would assume Texas is as crazy, if not as crazy as what we're seeing nationally, just in terms of bidding wars and values and all that activity.
Absolutely. Absolutely. And we're seeing that in all of our markets, particularly in our larger metropolitan cities like Houston and Austin and Dallas. We are absolutely seeing those bidding wars. I would say maybe to a lesser extent in some of our more rural areas, and not quite as severe in other. Our second largest market is Kentucky. And our largest state, and I would say while it's pretty severe there, it's not as bad in Kentucky. Interestingly enough, and I shouldn't be surprised by this, but we've seen a large influx. I mean, I think there's been a lot of in the news about folks coming from California to Austin, sort of following the tech and the space growth in that area, moving to the Austin area. But one of the things that kind of took me by surprise was I'm hearing from my branches in Kentucky that they're even seeing folks from California moving to Kentucky as well. So I think, I hate to say it, but folks from California are moving out. They're looking for other places that are more affordable, and Texas and Kentucky and some of our other markets are benefiting, which is wonderful. But it is having an impact for sure on our prices, and it's probably going to continue to see that.
Yeah, anecdotally, we've been hearing that, more people moving from the coast to the middle part of the country. The work from home aspect of that, maybe not needing to live where they work, making that a little bit easier for people. But now we're starting to see it in the results. And this month's existing home sales report, I think, was the most notable to this point representation of that, with existing home sales in the Midwest up month over month, but the coast down. So be interesting to see how that plays out, and if we do have sort of a little geographic shift of sorts in the country, where there are perceived to be some lower costs to homeowning. So
Agreed.
This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Republic State Mortgage President Paulina McGrath. Paulina, we're waiting on the much bandied about Supreme Court hearing decision on the fate of Fannie and Freddie. Essentially, it would give the Biden administration potentially the power to replace the current director of the CFPB, Mark Calabria. Would love to get your thoughts on that matter. Just, your interactions with Fannie and Freddie in general, the whole 7% non-owner thing, just your thoughts on everything kind of FHFA and GSE related.
I think like everybody else, we're sitting on the edge of our seat waiting to see what the Supreme Court is going to do on that case. I think it could have some very big implications for the mortgage industry. I think that, the replacement of the FHFA director being, of course, one of them, he has just been so adamant about just some of his stance on the GSEs has been very difficult to work with. I would just have to say, I think that if we can get a replacement in the director's position, if we could possibly see a suspension of the new PSPA restrictions, I think it would go a long way towards increasing home ownership for sure, and across the country. I don't know that the administration is fully aware of the impact of some of the restrictions that have been placed, and what that's doing to the low to moderate income borrower. I mean, their desire to want to increase home ownership with the low to moderate income sector of the population, in particular with minorities. With this new stance, it's just going to make it more difficult and more costly for those folks to achieve home ownership. So we really need a change at the top at the FHFA, and we're hopeful that this new, that when we hear from Supreme Court, that we may get the changes that we're looking for.
Thanks, Paulina. Moving on to just some general business climate issues. Just the competitive climate in general, recruiting of loan officers. It feels like it's a very competitive just climate right now. Things were so busy last year. Lenders were just fending off volume. We get into 2021, January was a big app month, bigger than I think a lot of us were expecting. And it's been a little up and down since then, but it feels like lenders are kind of settling in now, where they can really look out into the horizon and just strategically start to implement their strategic vision. If it's growth of their distributed retail channel, growth of another channel, whatever it is, it just feels like in talking to our members for the first time in a long time, they are in kind of moving the chess pieces around the board phase. I guess, one, do you think that's accurate? And just from a competitive standpoint, like, how do you see the rest of this year playing out? Do you see a lot of M&A? Do you see a lot of movement of LOs? Yeah, I would just be interested in your thoughts on that.
I do think, I think you're absolutely right about that. I think folks have finally have a chance to breathe. I think last year's we were all scrambling so hard to take care of our customers and to handle with grace the volume that we had. That now folks are finally able to kind of take a step back and what's the next direction of our companies? What's the next things we need to be focused on? I do think that we are going to see more movement in loan officers. I think last year folks were just too busy to even consider leaving their pipeline behind or to risk losing some of that pipelines. Now I think that at least Republic is already starting to see movement. We've benefited from picking up some groups and loan officers that were not pleased with the way the growth was handled in their previous companies and wanted to go someplace where they were able to grow and didn't seem quite as chaotic as it may have been in their previous employer. So I do think that we're going to see some growth. I mean, I think, wasn't it the MBA that sent out one of their chart of the weeks where they showed just the dramatic decline in, or actually, I'm sorry, it was the increase in employee retention, loan officer in particular. It was a couple of weeks back, but I think we're gonna see that retention number start to decline. And I think we're going to see it industry wide. There's going to be some musical chairs, so to speak.
Yeah, you're right. I think that, when you have great, massive amounts of volume, any kind of strife or stress, our business, any business, it brings out the best and worst in companies. And I think there was a lot of great companies that handled a very challenging, from a volume standpoint, a lot better than others. And I think you're probably going to start to see some movement here and maybe more than we've seen in a long time in this industry throughout the rest of 2021 here. The other topic I'd love to get your thoughts on is just, lenders had to just operationally staff to the gills last year as much as they could, bring people in. I remember, like, at our conferences, like 2 or 3 years ago, having lender-led sessions about, like, ways to replace the loan processor with technology. And here we are 3 years later, and it hasn't happened. And mortgage lenders are just as human heavy, I think, as they've ever been, despite the fact technology has progressed. I think, though, the next wave of technology, the machine learning and predictive analytics and artificial intelligence, it's like not quite ready for the big leagues yet, but is knocking on the doorstep in AAA. Just your thoughts on that whole dynamic, the technology that is still coming down the pike, And I guess how much that ends up replacing humans, and under what general time frame this all could start to happen.
So I think that you're absolutely right about AI and other sort of software like that that's been able to sort of speed up the decision making, or speed up the process from application to close. I think that that has been a huge focus of the industry now for many years. But I do think it's taken longer than anyone anticipated to really catch on. I mean, we've looked at quite a bit of it. We looked at quite a bit of it last year, but the lead time and the cost involved in a lot of that AI, for sometimes limited returns, or unknown returns, because there aren't that many folks that have truly embraced it. So you're really looking at the folks that are just first to market type folks that are willing to take that risk. I do think that the technology that we've seen in the industry over the past few years has absolutely helped us tremendously. I mean, when I think of the growth of our volume last year versus the growth of our employees, there's a big contrast there. We were able to do significantly more volume with not the same growth in terms of employees. I mean, we absolutely, don't get me wrong, we absolutely grew by, I think it was 43% year over year in terms of employees, but we grew more than that in terms of volume. So I do think that there's no doubt that technology has played a large part in that. But I don't think we're quite there yet on the mainstream AI, so to speak. I think it's going to take a little bit more time.
This is the last week in Mortgage Today. Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Republic State Mortgage President Paulina McGrath. Just a couple minutes left with Paulina. Paulina, another work from home. I guess our members in general, I'm, over generalizing here, but, it was last March, like, oh my God, like we were close to doing it, but didn't do it. March 13th of 2020, like everybody did it overnight. You fast forward, once the 30 days of just terror surpassed, you get to April, late April, lenders are like, okay, we're not going out of business. The world is not ending. And our people are so productive. Work from home works. It's great. And into the summer. And then people started to get burned out a little at the end of the year. And every operational employee was like, their sanity was being tested as we got into holiday season. And now we just did a big round of collaboration labs for our members in these last couple of months. The general mindset of our members is work from home was amazingly productive last year because people were happy to have a job. There was nothing else going on and they were just cranking it out, being happy to work from home. And then, but as we move forward, like into this year, there was more concerns about it. Like I think business owners more concerned about understanding how productive their employees are at home, wanting on various levels to monitor it and speaking to lower levels of productivity versus past similar levels of volume cycles from people in the office. Where are you at with all that? Work from home. I guess talk to me about that issue to close us out here.
So one thing that, and this is probably a topic that will take longer than a few minutes, but I'm just going to very quickly tell you that Republic has been doing the work from home thing for years and years and years. So we are not, last year was not as big of a change for us. Obviously some of our, the branch offices, satellite offices, those folks were not used to working from home, but in terms of our core operations staff, our underwriters, even a lot of our executive team, they've been working from home for years. And so there was not a huge shift. And we are going to continue to allow that because Republic State Mortgage has always believed that, you want the right person and it doesn't matter where that person is. So we embrace it and we're going to continue to embrace it. And we have faith that our staff is going to continue to be efficient and productive.
It's awesome. Yeah. And there was some big labor study that came out over the course of the last week or so. It's like 25, 26, 27% of all Americans said like work from home is now, it would be, if they couldn't do it, it's a game changer for them. Like they need work from home to the point where it would impact whether or not they would stay with their current employer or how they would choose a future one. So, yeah, I know that's cool to hear. I remember in New Orleans, our winter conference, a month before the all hell broke loose last year, I helped lead a session with a couple of our members, like Republic State, that had always been work from home. It's like 80 people in the room, and like everybody was just on the cusp of, like, felt like it made sense, but hadn't done it yet. And then a month later, everybody was kind of forced to overnight. But the companies that had been doing it, man, did it help them last spring and summer. I'm sure it did for you guys. So, well, Paulina, thank you very much. Really enjoyed the conversation, and appreciate you joining me for the discussion this afternoon.
Thank you for having me.
And to our audience, as always, thank you for taking 30 minutes out of your Tuesday afternoon or late morning with us for the Last Week in Mortgage Today. As always, we'll be releasing this to our YouTube page and also as a podcast, where I know a lot of you watch or listen as well. Until next Tuesday at 2 Eastern for the next edition of Last Week in Mortgage Today, I'm Rich Swerbinsky with the Mortgage Collaborative. Have a great week, everyone. Take care.
Bye-bye.
Bye, Paulina.